Joining me now at Post 9, Jimmy Chang of the Rockefeller family office. Welcome back. It's nice to see you. You say in the notes today that the market psychology has been altered. In what sense?
Yeah, I think prior to the recent sell-off, there was this expectation of a Goldilocks environment with the Fed about to cut interest rates. At the same time, people expect a soft landing. But then we got a number of economic releases that tend to point to a somewhat weaker than expected environment. You saw the city surprise index already falling below zero for about 2 months now. And then on top of that, the trigger for the sell-off with the Bank of Japan, unexpected rate cut, along with a weak jobs data. So that led to this so-called unwinding of the yen carry trade. But I think while that issue is put to rest for now, given that the BOJ has capitulated and indicated they're not going to cut interest rates, given the elevated volatility, I do think there's a sense of less conviction about the state of the economy. There's more concern that bad news could potentially be bad news for the market.
Do you think that the upset last week in the market was warranted? Was it justified, or was it an overreaction to, let's be honest. I mean, the labor market, the labor report may have been a touch disappointing, but it's kind of a stretch to suggest that it was really weak.
Yeah.
Still at 100 and something thousand jobs.
Right. I do believe that coming into July, the sentiment was extremely euphoric. And you start to see a little bit of correction leading into month end. You saw the big tech selling off. You saw the rotation into small cap stocks. And back then, they were also doing the Trump trade. But since then, a number of things have changed. I think the election is now too close to call. There are actually people talking about a potential blue sweep now, with Kamala Harris gaining a lot of momentum. So I do believe that the market was due for a pullback. And this was just a catalyst, happening with the BOJ being, given this unexpected rate hike. So that was an easy excuse. And I do think what happened on Monday was overdone, especially that 12% drawdown in Japan that bounced back very quickly. And that was all tied to the yen's action.
You point to the debate over mid versus late cycle. I don't know if you heard the conversation we had at the very top of our program with one of our guests making the argument that all cycles come to an end, and this one's probably getting close to the point that it is, certainly implying that we're more late cycle than maybe some would like to believe. How do you weigh in on that?
Yeah, that's a big question right now, and there are no conclusive data at this point. We have very mixed data. If you believe that we're in the mid-cycle, meaning there's several more years of expansion, every pullback is to be bought, because in that context, earnings will continue to grow. You're still in the middle of a bull market. If you're more cautious that we're perhaps close to the beginning of that late cycle or already in the late cycle, then the pullback may be part of a topping process, in which case you want to get incrementally more cautious. And again, at this point, it's hard to say because we do have additional stimulus coming into the economy. If you talk about the employee retention tax credit, the IRS just announced on Friday they're resuming payment of that very strong, very powerful stimulus, and that's coming to the rescue. Beyond that, we also have another $300 billion in the overnight reverse repo that will get shifted into the market between now and year end. So those will keep the market somewhat elevated. But beyond that, I think it gets really tricky after the January election.
Your positioning perspective sounds to me to be cautious. I mean, income-oriented investments are better than equities, you make the argument. Defensive parts of the market are better than perceived offensive parts of the market. Mag 7 stocks are likely to go sideways. Have I characterized your view correctly?
Yes, indeed. And that stems from the valuation differences. If you look at interest rates, we have normalized to the pre-great financial crisis levels, and the Fed is about to start cutting interest rates. So that makes fixed income relatively more attractive. Equities on the index level still look pretty expensive on a valuation basis, and part of that is due to Mag 7. I do believe that Mag 7 is likely to mark time for a while to let the earnings catch up to valuation. And at the same time, the other part, the rest of the market looks more interesting. And indeed, some of these dividend-paying stocks, telecom equipment stocks, for example, you get PE below 10 times, you get 5-6% yield. That combination is pretty attractive in a normal market.
What kind of volatility do you think we're going to have between now and the election? Was last week a warm-up act for what you could have based on polling as we get closer to Election Day? You referenced some of the more recent polls, which suggest a much tighter race, if not a different potential outcome than some were gaming out not a month ago.
Yeah, I do believe volatility will be elevated relative to where we have been in the first half. However, I doubt that we'll shoot up to 65 intraday like we did on Monday.
Yeah, that was something.
Right, but something between 20 and 30 is likely.